Today, we're cracking open Warren Buffett's 1977 shareholder letter. And trust me, inside this nearly 50-year-old document is a timeless investing toolkit that is absolutely essential for any professional investor today.
All right, let's just start right here. With this one sentence, Buffett is basically waving away what most companies today would shout from the rooftops as a win. This is a direct shot at the obsession with headline earnings growth, and really, it's the key to unlocking his entire philosophy.
So here's how we're going to break this down. First, we'll tear apart the myth of record earnings. Then we'll find a much better way to measure success. We'll get into the power of industry dynamics, lay out a super practical checklist, and then wrap it all up with the big mindset shift that changes everything. Okay, first up, let's really dig into why Buffett was so unimpressed with the #1 metric that still dominates the news every single quarter: record earnings per share.
He makes it so simple with this analogy. Think about it. If a company keeps its profits instead of paying them all out as dividends, which, most of them do, then its pile of capital gets bigger. And just like a savings account, that bigger pile of capital should automatically earn more money next year. It's just compounding. So hitting record earnings isn't some amazing feat of management. It should be the absolute bare minimum expectation.
So if just looking at earnings growth can be a trap, what should we be looking at instead? Well, thankfully, Buffett gives us a much better yardstick for figuring out what's really going on. And here it is: return on equity. Now for Buffett, this isn't just another boring financial ratio. This is the ultimate report card for a management team. It answers the most important question. For every single dollar of our money that you decided to keep in the business, how many cents of profit did you actually generate with it? That is the real measure of skill. And he wasn't just talking a big game. He was putting up the numbers. In 1977, Berkshire delivered a 19% return on equity. He made a point of saying this was way above what the average American company was doing. This wasn't just growth for growth's sake. This was smart, efficient growth. And this is where it all comes together. That 37% jump in earnings per share, it looks incredible on its own, but Buffett immediately gives you the context that matters. The capital base he was working with grew by 24%. The real magic, the true measure of performance, is the spread between those two numbers. That's where you see the skill. But for Buffett, the analysis never stops at the numbers. One of the biggest lessons in this letter is about something much more fundamental: the nature of the business itself. And he learned this the hard way, right inside Berkshire.
He lays out this perfect contrast. On one side, you've got the old textile business. It was just a constant, brutal fight against what he called industry headwinds. They were working hard, but getting nowhere. But then, on the other side, you had the insurance business. There, the industry had these powerful tailwinds, and he says something amazing. It was a business where you could make a few mistakes and still get a great result.
And the takeaway here is just so critical. It's often way more important to be in the right boat than it is to be the best rower in the world. You could have a genius CEO, but if they're in a terrible business, they're fighting a losing battle. A decent manager in a fantastic business, though, they can look like a superstar. So this all leads to the really practical part. How did Buffett actually turn these big ideas into a process you could use over and over again? Well, he laid it out in this incredibly simple, incredibly powerful checklist. And there it is, 4 simple rules. And notice how they all connect. Favorable long-term prospects. That's just another way of saying tailwinds, right? And the most important part is that he makes it clear he uses this exact same checklist whether he's buying an entire company or just buying some shares on the stock market. And you can see this checklist in action right here in his actual portfolio from 1977. Just look at the gap between what he paid for these businesses and what they were worth. That's not just getting lucky. That is the direct result of patiently applying that 4-point framework over and over again. All right, let's bring it all home. Because all of these ideas, the road, the tailwinds, the checklist, they all build up to one central, powerful philosophy. It's a total shift in how you're supposed to look at the market. This right here is the secret sauce. For Buffett, the stock market is not a casino for betting on squiggly lines. It's a marketplace where sometimes you can buy pieces of fantastic businesses at prices you could never, ever get if you tried to negotiate a private deal to buy the whole thing. It's a beautiful arbitrage between public perception and private value.
And he makes this incredible, almost counterintuitive point using his investment in capital cities. He says, look, these guys are extraordinary managers. Why on earth would I want to buy the whole company and try to run it myself when I know I could never do as good a job as they do? By just buying a piece of it, he gets all the benefit of their amazing talent without any of the burden. It's a seriously profound way to think.
So here's what you should really take away from all this. It's a four-part framework. Judge companies by their return on equity, not just their EPS. Hunt for businesses that are riding strong tailwinds. Be disciplined with a simple checklist. And above all, always remember you're buying a piece of an actual business, not just trading a ticker symbol.
And that brings us to the one question that this entire letter from 1977 really forces us to ask ourselves today. When you look at your own portfolio, at your own process, are you just buying stocks, or are you truly building a collection of great businesses?